everyone. Welcome to another session of our education series about everything you need to know about money, business and accounts. For those of you who don't know me, I'm Lucy Cohen. I'm the co-founder of Mazuma. We are micro-business specialists, subscription-based service for micro-businesses. And we're having a chat today with Danielle, who is our longest serving and most long-suffering member of staff, about one of the most common questions that crops up when people sign up with us and when clients sign up with us, or even when starting a business. And it's about, if you've got a limited company, how on earth do you take money out of it? Because with a sole trader, it's kind of fairly easy breezy. But with a limited company, how do you get the money out of it? So Dan, let's assume I know nothing about this, which to be perfectly honest, you definitely know an awful lot more than me. How do you do it? You're running a small limited company. How do you take money out of it?
Okay, so there's three main ways that we would look for you to extract your money. So the first one would be through a salary. Your second one would be through dividends, and the third one would be through the director's loan account.
Okay. So what does salary mean then? So everyone knows what salary is. You get paid, someone else sorts out your tax, job done. Is that the same in a limited company?
Pretty much it is, but there's three sort of levels that we look at depending on the client's needs. So the first kind of level we've got is something that's below the LEL salary, so that's the lower earnings limit. So that uses up a bit of your personal allowance, but not all of it. You don't have to submit any payroll to HMRC, so admin-wise, it's very minimal. And there's no tax or NI on that. So that's a really straightforward, easy way of doing it, but it's not the most tax efficient way if you haven't got any other income that's taxable. Cool. So it's something that they're there to use, but it's not the most tax efficient way of doing it.
What if like, say I've started a limited company, I just decide to pay myself like a 40 grand salary. What happens then?
So it's not what we would recommend unless you were expecting not to make any money from the business. So obviously, if you're going to take that level of salary, you're going to have personal tax, personal NI, but there's also then employer's NI. And if you're the only person employed in that company, you're unlikely to qualify for the employer's allowance. So you really are going to suffer kind of higher rates of tax. Not really worth you trading as a limited company if you're going to do that.
Yep, so that's some pretty sound advice there. Okay, anything else around salary?
So we recommend one of two levels. So we recommend a level that's either just below the employer's NI allowance, the employer's NI amount.
Okay.
So that you haven't got any extra taxes to pay. It uses up some of your personal allowance. You do need to do payroll and submit RTI with it, but it's a really easy and cost efficient way of running it. Right. However, if you want to go for maximum input and you have other employees, so you're going to use the employer's allowance, we would recommend putting through your sort of personal allowance amount. There's only a little bit of personal employers NI and a little bit of employers NI, but if you've got other employees and you can get the allowance, it's a really cost effective way of doing it.
Great, lovely. So move on then. Dividends. There's a lot of stuff out there on the internet. Salary versus dividends. What is a dividend, first of all?
So dividend is the distribution of profits from the company, and that is the key word there, profit. So you have to be making a profit for you to be able to dish out dividends to the shareholders of the company. And that's the other thing, you have to be a shareholder to be able to get a dividend. So if you're making a loss, you're not getting a dividend. And if you're making a profit, it's profit after tax. So that's after your corporation tax.
Got it. So HMRC take their cut first.
Yeah.
And they are taxable, though, dividends. Years ago, they were more generous, but they are taxable, and you put those in your personal tax return?
Yep, so it goes on your personal tax return. So there's a currently tax-free amount of £2,000, and then after that, it's subject to tax, but not national insurance. So that's where you kind of make a saving compared to being a sole trader. So we would recommend that you do a dividend voucher and you hold minutes, so you've got all of the paperwork to back it up. But yeah, it goes on your personal tax return at the end of the year to declare your taxable income and pay any tax over to HMRC.
Right, and I think something that Danielle really touched on there is the importance of it being profit after corporation tax. You need to be able to prove that at the point you pay the dividend, you knew you were in profit. Otherwise, they could be classified as illegal and incur additional taxes.
Yeah.
There we
and
are.
penalties. Yeah,
that's it. So get it right. So that's a core message there. And then director's loan account. What on earth is it? How do you get money out of it? Go.
So director's loan account is effectively any money you've put into the business, so anything startup money, any money you've taken out when there weren't any dividends available, maybe a repayment of expense where you've paid an expense personally out of your bank account, but it was for the business. So it's a mixture of all those different things. If it's in credit, that's money owed to you from the business. You can take that out and it's tax-free. If you go of what we call overdrawn, so it's in debit, that means you owe the company money. You don't want to go over £10,000 for that. If you go over £10,000, it incurs additional tax for you personally and for the company in both ways. So you'll have to go on a P11D, so the company will pay employers NI on it and you'll pay tax on it. And then the company's also subject to another corporation tax. Because it's a loan. Yeah, it is repayable, so the tax is repayable once you've repaid that director's loan, but just stay below the 10 grand.
Absolutely, yeah. I always think of director's loan being a little bit like, imagine you really are an employee of the company, or you are an employee of the company, it's your company, but you've gone on a business trip and you paid for something like your personal account and your employer is going to pay you back. That's really what a director's loan account is. And there's quite often a balance in there from when, like you said, people have bought stuff when they've started up, or they've done some mileage and paid for it out of their own pocket and stuff like that. It's sort of like an expense account, but if you've got a balance in there, taking that out is tax-free as long as you're not taking out more money than is available in there, going overdrawn on it.
Yeah, that's it.
Brilliant. So there we are, 3 ways. We've got salary, we've got dividends, we've got director's loan account. If all that's a bit overwhelming, we always say speak to an accountant about it, because they'll make sure that you're doing it right, even if it's just to set up the systems and give you a bit of advice. Hopefully you found this video useful, and hopefully we'll see you again at the next one. Thanks very much, everyone.